Let's now turn to Equity Trustees' outlook for the Australian economy in FY26, how that's informing investment decisions. Darren Thompson joining us from Equity Trustees. Welcome, good to see you again.
Hi Andrew, great to be here again.
Let's first start with the macro backdrop, how you're seeing the Australian economy travel at the moment, and I guess we just heard from the RBA, they think it's still in a pretty good place, hence they leaving rates on hold. What's your view, and I guess perhaps how that's likely to influence earnings going forward?
Yeah, look, without wanting to bore people, I'd like to echo a lot of the comments the RBA made earlier this week when they decided to leave rates on hold, and that is that the Australian economy is in a solid place, not particularly exciting, but solid. Obviously, we've got low unemployment, steady growth, a lot of public-led investment. So obviously, I think the baton has to be picked up by private investment to sustain growth. But overall, it's in a solid place. Mid-twos growth, a little bit below trend, but okay. Certainly, I think there's a very high degree of certainty around rate cuts. 2 rate cuts for the rest of the year, with the first of those being next month. So look, I think the Australian economy is in a solid place, and the RBA governor sort of outlined that. Good underlying demand, reasonably solid discretionary spend. So there wasn't like a compelling case. Probably one thing that I think was called out is just little pockets of inflation, and certainly in the construction sector. Anyone who's undertaking any building activity would probably see that. There's a lot of adverse variations if you're building at the moment, and certainly in that area there's a bit of inflation, but overall a solid outlook.
When we look back at the past 12 months for the financial year, those returns have been pretty impressive for the equity market. Is that sustainable, do you think? And as a result, what's your positioning going into the new financial year?
Yeah, no, so we've had another really solid year. So obviously the financial year we've just signed off for really strong double-digit returns for a lot of our clients, leverage to growth markets, driven by growth markets. I think the prospects are for more muted returns in the next 12 months. Certainly, and I think as your previous guest was talking to, we've had sustainable earnings downgrades in our market, but the market's been up. So it's been all rating driven that's driven that upside. Our outlook is for modest low-digit EPS growth over the next 12 months. And given the market's at a reasonably high multiple already, I certainly don't think there's any multiple expansion to come. So we'd be sort of suggesting that mid to high single digits would be a good expectation for the next 12 months, particularly from growth markets, from equity markets. And if you look at fixed income, you're probably looking at 5 to 6% at the conservative end of the market, government bonds and so forth, with a little bit of rally in bonds, and maybe 7 to 8% when you go higher up the credit curve.
Let's take a look at the risk and opportunities as you just see them right now. Beginning with the risks, what do we need to be mindful of, do you think?
Well, I think the obvious risks are probably the geopolitical or the policy issues that are coming out of the States and how that manifests themselves in terms of economic growth, particularly out of that economy. I think it's going to be a few months before that really plays out in any great degree. So I think those sort of, knee-jerk policy changes are probably one of the key risks. Here in Australia, it's always dangerous to say, but there's not necessarily obvious things that are going to derail the economy or really turbocharge it either. So I think it's a relatively narrow band that we're operating in. Certainly, bad debt cycle looks pretty good for our key banks. Commodity prices are clearly a factor for us, but again, they've stabilised. So again, I think that there's modest upside potential, but certainly that's stabilised. So I think the risks are really around any adverse outcome to consumer sentiment, which would impinge upon discretionary spend, and that private sector spending picking up the mantle from public. I think that's probably the key risk, that we sort of peter out and we sort of ebb away in terms of growth.
What are the opportunities, and how would you be playing those in terms of asset classes and sectors that you're favouring at the moment?
Yeah, so certainly, I guess echoing those comments, the growth asset classes I think are relatively, arguably got a bit of complacency. Certainly they're looking through that volatility, uncertainty in terms of the rating, I would say, that's being applied to them. So we're a bit cautious on upside from domestic markets and growth assets. But where we still think there are good sectoral opportunities. So certainly we're skewed towards healthcare. It's been a sector that has underperformed relative to other classes. So stocks like CSL, ResMed, TLX, there's a little bit of, uncertainty around policy and tariff policy that's, I think, impacted the pricing of some of that sector. So that's certainly an area we like. And probably real assets. So in an area where we're probably very likely to be getting rate cuts, but a stable environment, certainly real assets like infrastructure and property, I think should do pretty well.
Equity-wise, there's been signs perhaps of that rotation out of the banks
Yes.
into resources.
Yes.
Do you think that is now well and truly underway?
I think it is. As much to do with the relative value, I think, of the banks, and the CBA valuation obviously has taken up a lot of airplay given the size of that is in the market, and that certainly does seem to be particularly stretched. So we would see better value elsewhere outside of the banks and certainly outside of CBA. Probably less valuation heat, if you like, in the other banks, but certainly the CBA phenomena is interesting. And certainly the last 12 months has been a market where momentum has been a very powerful factor. Momentum has been one of the key drivers, and certainly at some point in time we would argue that valuation will assert itself. So I do think that rotation has probably just started and probably has a little way to run.
Where in resources do you want to be then?
Look, in terms of, I think copper was mentioned.
Yeah.
Now there's obviously noise around copper at the moment with tariffs and so forth, but certainly we think there's upside in copper, and we also hold South 32 and think there's upside in that stock. The iron ore names, again, whilst we're not looking for a big uplift in iron ore pricing, certainly they're very strong cash generative businesses, very steady, pay good dividends. So there's a lot of resilience there. I guess the key thing for our resources will be where do they deploy that capital going forward, and being capital disciplined as we go ahead. So they'd probably be the key areas.